Hi, welcome to the Joe DeLisi Financial Advisor podcast. I'm Joe DeLisi. Today's Monday, June 30th. We're going to talk the big, beautiful bill, the big, beautiful tax bill that is currently being, I guess, moved through Congress. I can't even pretend to follow all of this. I mean, probably a lot of you guys are way better versed than I am on how reconciliation works. I do remember way back in 2007, 8, that time frame with Obamacare. That's how the Democrats got that legislation through. So I'm a little familiar with it, but not. I mean, obviously, I'm no expert in that area. But if it's taxes, I want to talk about it because that's gonna impact my clients. So today, I believe. Let's see. So it got through the House. It is in the Senate. It passed some hurdles in the Senate. I believe they're going to debate it. I think they were debating it last night, and then it goes back to a vote. And so we should know something soon. I mean, it's supposed to. I think it's supposed to be July 4th is some sort of deadline. Again, your guess is as good as mine. It's really hard to follow this stuff. So we're not going to deal with that. We're going to deal with not even the bill itself because it's 1,000 pages long. I doubt any of our politicians are really reading it, let alone me or you. But I want to talk about taxes in general because, look, we're going to have different administrations. We're going to have different Congress is going to be controlled by different parties over the next 20 to 30 years. And that's really what you and I are dealing with. We're not dealing with the next 4 years. We're dealing with the next 20 or 30 years, even if you're within 5 years of retirement. So, my first big disclaimer before we get into some numbers here is I'm not a CPA. I am not a tax expert. I don't prepare my own taxes. I don't prepare my clients' taxes. I do, however, work on what I'll call income statements. So we've got an investment policy statement, and that would be how we're going to build and maintain your portfolio, your investment portfolio. Obviously, I work on your balance sheets for you, and that's beyond portfolios. That's debt and cash flows and protection items and all of that stuff. But we also are looking at distribution planning. And we don't do that at the day of distribution. If you're a business owner client of mine, really we're looking for 7 years would be perfect, at least 5, but 7 years, maybe even 10, to sort of plan your exit out of the business in order to prepare income for you. And really it's the same is true for my high income W-2 folks that are watching or listening. By the way, we're back from our southern vacation in Florida where there's been no video, obviously, just podcasts. We're back with video so you can see the results of my early morning jiu-jitsu beat down of my face this morning. So an income policy statement is not investment related per se. It's really what it sounds like. It's okay, where are we going to get the income from? We've got all sorts of different buckets. How are we going to take that out? Because net cash flow is the game. Gross cash flow doesn't matter. It's net cash flow. And that really is going to deal with taxes in a lot of different ways. It doesn't matter if you're exiting a business and retiring at 45, or if you're exiting the corporate world and you're retiring at 55 or 65 or whatever it is. So let's get into the taxes a little bit here. Let's talk about the debt too. I've got a bunch of notes here on where we've been with taxes. And, if you look at the national debt, we're over 36 trillion now. I don't believe that either party is really seriously looking at cutting the debt. It just continues to go up. I believe that we're paying over $1 trillion a year now in interest on that debt. And so why am I bringing that up? Well, look, I mean, if they're not going to cut, then the politicians, have to increase taxes. I mean, that's kind of math. And I don't even know that they can increase them enough to deal with the debt, but that's a whole nother discussion. And so even though this bill currently is talking about extending or making permanent, I suppose, the 2017 tax cuts, nothing's permanent. I've learned that in the almost 30 years that I've done this. And so we have to look at taxes as, not a steady state. It's very likely that they're going to go up in the future. And I'm not predicting anything. I don't know. Maybe they don't. Here's what I do know. We have to be able to prepare your ultimate exit from the workforce, whether it be a business owner or a corporate employee. We have to plan your exit in a way that your income is a high net after-tax income, regardless if taxes are the same as they are now, higher or lower. We have to be very proactive with this. If we just rely on the fact that they're always going to be lower because that's what our industry tells everybody, I think that's a really big mistake. And here's why I'm going to say that. Let me kind of scroll down here and look at what a future tax increase might look like. And to do it, really, I mean, it's just whatever our politicians can dream up, but we can look to the past to see where we've been. And now history may not repeat itself, but it rhymes, is what I've heard. History can rhyme. So let's look at the past. Let's take a time machine back to 1950, okay? In 1950, there were 22 brackets for a married couple who's filing jointly. 22. Today, there are 7. In 1950, the top tax bracket was a 91% tax. So if you were, like today, if you're in the top tax bracket, you're paying 37% federal. And that would be on earned income and also some of your investment income, depending on if it's qualified dividends, capital gains wouldn't be taxed at that. But so it's not just your earned income, it's also your investment income that can be in that 37% top bracket today. But in 1950, that top bracket was 91%. And there's a chart that I've shown, I don't usually show it to clients because I don't want to freak you guys out, but I do show it to advisors when I do speaking and things like that. And what I'll hear from the crowd of advisors is that, well, hardly anybody paid that 91% bracket, and the overall effective brackets from back then are about the same as they are now. That's just not true. And I've heard that for so long that I actually had to go back and look, because I'm like, if I'm wrong on this, I'm wrong on this. Like, I'm okay being wrong. I don't want to be wrong indefinitely. So if I'm incorrect, I want to know. So let's go, and we're going to use CPI as our inflation, all right, to reverse engineer this. And so I'm going to apply it to 1950. All right. So stick with me here. In order to be in the 91% bracket in 1950, you had to make over $400,000 of income. Now that's in 1950 dollars. Okay. If I inflation adjust that to 2024, it means you had to make more than 5 million. So again, in just plain English, like if the 1950 brackets existed right now today, you have to make 5 million and up to be in that bracket. Okay. Got it. So that's where the advisors will say, see, no one makes that. And they do, but I understand their point. The point taken, like most people don't. Fine. Let's use numbers that I see more commonly, at least in my business. Okay. So on average, very non-scientific, but this is what I see. I'll say that, my W-2, my non-retired W-2 clients make roughly, I'd say $400,000 a year today in 2025 dollars. My business owner clients report on average about $800 in adjusted income. Okay. So if my W-2 clients were alive in 1950 and I reverse engineer that inflation, their adjusted income back then, so today it's $400,000. In 1950, that means they were making $30,000. Their effective tax would be about 32%, almost 33%. In 2025, their effective rate would be 21%. What I'm saying is, currently, if you're a high income W-2 and you're making $400,000 and over, right now your effective bracket is about 21%. But if the 1950 rates came back and we ran through those tax brackets, you'd be at 32, almost 33%. That's a big increase. My business owner clients in 1950 would be paying an effective rate of almost 52%. So again, if you're making $800 and up as a business owner or a W-2, and the 1950 rates came back into play now, you'd be paying an effective rate of 52%, not 27%, which is what $800,000 of income would put you at today. That's almost double. I mean, that's a scary, scary proposition. So, as the years went on, we had administrations like the Kennedy administration, Ronald Reagan. They greatly reduced the federal income tax brackets. But, in order to do that, they basically gave up a lot of deductions that taxpayers enjoyed in the past. And the result of that was a lower effective bracket today, but also less deductions, right? So if you had this chart in front of you, and I would just use the Reagan timeframe. I think he brought it down. I'm gonna paraphrase, the numbers here, but Reagan brought it down. So Kennedy brought it down from like a high of 91 into the 50s, and Reagan brought it down from in the 50s down to 28 at the highest rate. But both President Kennedy and President Reagan gave Congress something in order to get that. So what they said was, we're going to reduce deductions. So Reagan reduced deductions. And then what happened is the tax rates, and most of you lived through this, went from 28 at the high up to 39.6 over the years. during I think it was the Clinton administration. Well, when you go from 28 as a high to almost 40 as a high rate, but you don't get your deductions back, that's a significant increase. Because it's not just moving from 28 to almost 40, it's moving from 28 to 40, and you don't get all those old deductions back to reduce that income. So my guess is, like, I don't know, I don't know if politically we can get back to a 91% top rate, although there's a lot of talk about, hey, we got to tax the rich. We got to tax the rich. Nobody really wants to define who rich people are. They just want to tax them more. So if you're making $400,000, $500,000, $600,000, $800,000, or if you're a younger client of mine, say you're a 20-something child of one of my older clients, my existing clients, and you're making a household income of 180 to 250, and you're rising through time, you got to be worried about this. So how do we plan for this? How do we plan for this national explosion of debt and a big, beautiful bill that's really trying to keep taxes low? In the future, taxes may go up. What do we do? What do we do about that? Well, we have to be very efficient in investment portfolios. I'll start with that. I'll give you 4 ideas. One, our investment portfolios. And the great news here is, if you're a client of mine, your investment portfolios are ridiculously tax efficient. I mean, if you want to know, call me. We'll go through last year's 1099 that you got from the custodian, and I'll take you through it. Your non-qualified investments have a very, very low income taxations, mostly capital gains, especially long-term, and those tend to be lower than income. So if taxes go up in the future on income, your investment portfolio has to be tax efficient to utilize long-term capital gains and not the high income brackets. We have to take advantage, this is number 2, take advantage of things like Roth 401k elections, where you pay your taxes today and then enjoy tax-free withdrawals later. Now, not every employer has this. Not every business owner has this, but it's something that I always bring up, because a lot of you who are newer clients of mine don't even know that you have these elections that you can take on your 401k through your employer. So that would be a good one. Here's a small one, but number 3, I'd say you utilize the HSA, the health savings account. That's a great one. Unfortunately, you can only put some $8,000 into it in 2025. Maybe it's $8,600 or so for a family. But you get a deduction today, you get a deferral, and if you pull it out for qualified expenses for medical and whatnot, it's tax-free in the future. So it's a beautiful strategy. And then number 4, I would utilize and look at utilizing whole life insurance. The most obvious thing is the cash value there is all tax deferred and can come out tax-free. So we want to look at that. So where are taxes headed? I don't know. I don't want to predict the future. But I want your income policy, as I stated to begin with, in retirement to work no matter if taxes are higher or lower. I can't just set you up for success if only one thing happens. I wouldn't be doing my job. So we got to be proactive and not reactive. So as you listen to this and you see the machinations of the BBB, the big beautiful bill, move through Congress or not move through Congress, and the effect that has on your income taxes, just be aware that I'm aware. I'm not just looking at portfolios. I'm looking at your entire balance sheet and how this is going to work in the future, just like I do for my family. All right, now we're going to talk about compliance. Now, I would love to read this like in a funny way and make comments on it, but I'll get in trouble, so I won't. So I'll just read it. Registered Representative, Financial Advisor, Park Avenue Securities, LLC, Pass OSJ 5280, Carroll Canyon Road, Suite 300, San Diego, California, 92121, 619-684-6400. Securities, products, and advisory services offered through Pass. Member FINRA, SIPC, Financial Representative, Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC, not an affiliate or subsidiary of Passive Guardian. Insurance products offered through Westpac Wealth Partners, Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, California Insurance License Number OD34103. This podcast is for informational purposes only, not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers or firms are not affiliated with or endorsed by Past, Guardian, and Westpac Wealth, and opinions stated are their own. Guardian and subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market economic and industry conditions. This material is intended for general use. By providing the content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or to make recommendations for a specific individual or situation or to otherwise act in a fiduciary capacity. Past performance is not guarantee of future results. Indices are managed and one cannot invest directly in an index. 706-9617 expires October 2026.